Good morning, kids. My name is Regan Pike from the WeLoveKits team, and I'm joined today with Iain MacFadyen. He's one of our local top-notch brokers in the Vancouver area, and we're here to talk mortgages. So Iain, one of the questions that I'm asked frequently by my clients is, what do I need to do to get pre-approved? If I'm going out looking at a condo and want to put an offer down, what do I need to do ahead of time to find out what I'm qualified for?
Okay, well thanks Regan. It's a good question because a lot of people get pre-approval from their bank. This may not have a lot of work put into it. The bank can always take this back later on. So to be honest, the ones that people get from their bank is really just a rate hold. The bank will keep the rate for 90 or 120 days. They'll check the client's credit and they'll take their income at their word. So you can't really rely on it that much.
So sorry to interrupt for a second. So if I'm working with a client and they have that type of pre-approval in place and we're putting an offer down on a condo,
You gotta put subjects in there.
Subject to financing still, because they really don't have...
Definitely.
Okay.
Because even if the client got everything right, they knew their income exactly how the bank would use it. It could be a leaky condo, there could be something wrong with it. It could be a leasehold and that bank wouldn't lend on it. It could be a private leasehold and almost no banks would lend on it, and then that pre-approval is worth nothing. So with me, basically, as the broker, I can dig into the income a little deeper than the bank might do. So a lot of self-employed clients will know generally what they make a year, but they won't know their net versus their gross. If they incorporated, it might change things as well. So these can change things. Also, clients who are new at a job, maybe a year or even less than 2 years into the job, might be thinking, oh, I can qualify with my overtime or with my bonus, and they actually won't be able to. So the actual income figure could be a bit lower. So I'll have this conversation with the clients and we can basically suss out exactly what the income would be. We could then look at what the property taxes, strata fees would look at for a given property, put those into the equation, go through the qualifying, basically get a maximum budget, and that's what they can work at. I can also take their credit and see how their other debts would figure into the whole equation. So that's kind of what I like to do as a pre-approval to start, and then when they actually get serious to put in the offer, we can start to put together the documentation. So job letter, pay stub, tax documents, down payment documents.
How long would that typically take? I mean, not from the client giving you the documents, but just you're working with me, you're requesting the documents from me, I'm providing them to you. What would be a typical turnaround timeline to get everything done and approvals in place? And ultimately a dollar amount that I feel comfortable going forth and spending.
I mean, usually you can be 90% certain just sitting down with the client. If they know they have good credit, you can work with the figures they have. It gets more complicated if they have lower credit or they have certain debts. They're not totally sure of how they'd look on their credit bureau.
Okay.
But to take a credit bureau, it's literally going to take me 5 minutes of inputting their data or less and hitting a button. Take the credit bureau, I know what their credit is, I know what their liabilities look like, then that goes into the equation and go from there. And then to get their income really cinched up, I'd want to see the documents which they'd come up with afterwards.
Okay. You mentioned credit bureau, so what if I've got a down payment in place, I've been gainfully employed for a few years, I've got a great job, I missed a couple payments on a credit card, or how does that impact me when I go to get...
A few payments is not going to impact you very much.
Okay.
It will impact you if, say, you had a consumer proposal a few years ago, your credit's being rebuilt. In that case, I've seen people's credit fall just because they've had over limit, a few missed payments, that kind of thing. So if their credit's kind of shaky, those small things can really hurt it. If the client's got great credit, then a few missed payments or some parking tickets gone to collections not really going to hurt them.
Okay. What about, I mean, within the last year, there's been a new stress test that's been implemented in Canada by the financial institutions, by the government, really.
Right.
So, can you talk a little bit about how that's changed the market and what the financial lenders are looking at, and what's changed a year ago to today with that stress test in place?
Well, the stress test quite literally makes the clients need to qualify for a higher payment than they're actually going to pay. In the past, a fixed payment, a 5-year fixed, you would qualify for the actual payment for the 5-year fixed,
Okay.
but now you're basically qualifying for that 5-year fixed payment plus 2%. So let's say you're qualifying for a mortgage payment of $1,600,
Okay.
and then at the end of the day, you'll get one for, $1,350 or so. So it's basically brought everyone's budget down by about 18% across the board.
Okay.
Credit unions were exempted from this, but over the last year, they've basically come into step with the federal regulation. So everyone's stress testing now.
So when you said 2%, so if you're able to get me pre-approved with annual rate at 3.5%, then you're adding 2% on top of that, or is 2% on top of the prime rate?
No, it's going to be 2% on top of the fixed rate.
On the fixed rate.
Or the benchmark rate. So the benchmark rate is currently 5.34.
Okay.
Most fixed rates are the mid 3.5, around there. So either or. So right now it's the rate plus 2.
Okay.
And for all variables, so if a resulting variable is less, it will probably be lower. So they'll probably be 5.34. So whereas in the past it had been harder to get a variable rate, now it's actually harder to get a fixed rate because the variable rate's qualifying rate
Right.
is slightly lower than the fixed rate.
Okay. Iain, maybe you can tell the audience what lenders are you working with, and maybe what are some of the differences in the products that they have to offer?
Okay. Well, I deal with certain chartered banks, certain credit unions that you'll see around, and then there's broker-only lenders. They're called monolines in the business. So they source all of their business through brokers. They tend to be very good on rate. They also tend to be lower on penalties, which is very important. I mean, most clients don't go into a mortgage planning to break it, but things happen, or they need to refinance, take money out perhaps to buy another property. So having low penalties is a good feature to have. And they'll also allow you to prepay more of your mortgage per year than most lenders will. Credit unions are good for certain programs. They're also good with rental income, that kind of thing. Chartered banks are good for leasehold properties, certain income, sometimes lower credit, they'll be a bit more forgiving on. So it's good to have a good mix of lenders for any given situation. So with me, you don't commit to any lender, so we'll find the best lender to deal with.
What about in the situation, okay, for instance, I've got a 5-year fixed mortgage, I'm 3 years in, there's a wonderful property that I've waited all my life to buy across the street. I've got to have this house, but it means I'm going to break my existing mortgage, and the financial institution I'm with is going to ding me a lot of interest. What are my options as a client? Are there ways around that, or are you just basically, it's a type of mortgage and you're stuck, so you're going to have to pay off that 2-year hit and move on, and accept it as a way of doing business?
Well, we can estimate what the mortgage will be. Generally near the end of the term, it'll be a bit lower.
Okay.
So breaking a mortgage a year in versus 3 years in will be quite different. There's a possibility of porting your mortgage, so you actually take your mortgage to the new property, as long as you can, line up your sale and your purchase dates relatively well, and it's a property that the same lender wants to lend on.
What if you had a gap of a month or two? Will that be an issue?
No, it's usually 90 days.
90 days, okay.
Yeah, with a lot of lenders. So a lot of times they will charge the penalty when you sell, and they'll reimburse it back to you later on after you've bought the new one.
After you've locked down the new mortgage with them.
Yeah,
basically.
Yeah, exactly.
Okay.
So that's a port. Otherwise, it might make sense to just pay it out, to have the flexibility to go looking for a new property. Or in certain instances, you'll need to, you might want to buy and then renovate the old place and then sell and have two mortgages for a time.
And what would be the, you said 90 days, would you have longer? Like, would you have 6 months in that instance to do the work and get everything settled? Or
In a port period, no.
what would be
really.
the maximum time?
For a port, would be about 90 days.
90 days is a maximum, okay.
Yeah, and in certain instances, it could even be shorter.
Okay.
So ports don't always work. You may be consider to keep your old property as a rental.
Thanks for your time today, Ian. Appreciate it. I hope all the viewers enjoyed what you had to offer. On our websites below this video, we do a contact us form. If you want to be contacted by Iain and find out what you can qualify for as a mortgage, please fill that out and we'll get the information over to Iain. And thanks everybody. I hope you enjoyed. And again, Iain from Vanderkamp Vancouver Mortgages.
Great. Thanks for having me.
Thanks again.
All right.